From the trading desk of dailyforex.com, this is Christopher Lewis looking at the upcoming June 22nd Forex session. As you can tell, I have the euro dollar pair in front of you. And the reason I'm looking at this is because it's starting to show a very interesting pattern. First, we should probably talk about what happened on Thursday. This is being recorded just after the day close, so this is actually Friday's candle. Starting to be formed. But Thursday, you can see that we did get a breakdown of what was pretty much a shooting star. Kind of messy. It didn't like the signal per se in and of itself, but considering the trend's most certainly down, it was a reasonable signal, and as such, it was a sellable signal. But looking at the euro, you can see that this features two currencies. One that is the epicenter of everything that's concerned about in the world, the euro itself, and then of course the quote-unquote one of the safest currencies, the dollar. So it does make sense that it is starting to grind lower. It's interesting because there seems to be a bias in this pair, and I do get emails and messages every once in a while asking me why I'm so anti-euro. And it's really not a matter of being anti-euro in the sense that I think people out there desperately want the euro to rise. I think it's because it's what it does over the last several years. Is it just eventually rises, and people become emotionally attached to their trades and get upset when people like me come out and say that the euro is falling. But the sad truth is when you look at this chart, you really can't come up with any other conclusion. Plus, you have to think about what truly is going on right now. There are serious questions being asked about the monetary union itself. The euro itself may not exist in a couple years. When you compare that with the US dollar, and the big thing that's always brought up is the fact that there's a large US debt, and that by all means, there certainly is. But having said that, we don't have a situation in the United States where Missouri and Idaho and two or three other states, Texas, Florida, Mississippi, are looking to bail and bring down the monetary union. We don't have that situation. In Europe, you do. It's a huge difference. It's one thing to be laden with debt. It's another thing to have people wondering what currency they're going to get paid back in that debt. And that truly is a big problem. Think about it. If you loan millions and millions, and in the bond markets, that's how it works. We're not talking about people going in and buying 5,000 euro bonds from the Greeks. We're talking about institutions, millions and millions of dollars going into, say, Greece or Portugal or Spain or wherever. Well, if they have to worry about whether or not it's going to be a euro or a peseta or a drachma or something that's paying them back, that causes a lot of anxiety. Having said all of that, looking at the technicals, you can see that I do have a Fibonacci drawn from the last fall, and I also have the 125 and the 130 levels laid out. So 125 to me becomes very important, and the reason being is, and I have to use a little bit of artistic license with this, I freely admit that, and get a spike here and a spike there. But for me, I think we have a bearish flag forming. Now, if we were to break down below this flag, and we did press up against it during the session on Thursday, we would face the 125 right away. So for me, I'm much more comfortable adding to sell positions below 125 on a daily close. If we get that, you measure the pull of the flag, and at this point in time, this is really rough math, but it's roughly 1,000 pips. And from the point of the breakout, which I would call roughly 125, we're looking at a target of 115. Seems kind of outrageous, but when you think about it, the Europeans are going to be going through austerity for quite some time. They're also going to have debt issues for quite some time. So it wouldn't be much to think of the Europeans going into a recession for a couple years, quite frankly. Also, 115 is a level that many analysts out there have called for over the course of the next couple of years. It's not, I wouldn't be the first person to suggest that that could be possible by any stretch of imagination. And on top of that, when the euro was introduced, it was introduced at 118. So really, in the big scheme of things, it would only be a slight loss for the value of the euro. If you think of it in dollar index terms, it would be something along the lines of the Dixie going down from 100 when it was implemented to, say, I don't know, maybe 95 or so. It's not a massive drop. So all these things are doable. Now, it will take some time if this happens. There will be a lot of bounces in the meantime, but if we break the bottom of this flag for the next 1,000 pips or so, and this could be a couple years, don't get me wrong, this doesn't necessarily have to be a quick move. I will just simply be selling the rallies like I have been doing for some time now, and it's worked out quite well. And as long as there's chaos and drama in Europe, there are a lot of traders out there who simply won't want to be bothered with it. And as such, this will be in a downtrend. If we do get a pop from here, and it looks at the opening like we could possibly do that, I'm really not interested in buying unless we break the top of the flag. And even then, I really think 130 is the real test. I think any rallies at this point will simply be selling opportunities.